Welcome to our guide on choosing the right stocks. Whether you're a seasoned investor or just starting out, these steps will help you. Tired of your money sitting in the bank? Put your cash to work in the stock market, but hold your horses. Let's equip you with the knowledge to succeed. Arm yourself with tools and insights. Navigate the highs and lows of the market. Unlock the secrets to building a proud portfolio. Listen up, folks. Before you even think about buying a single share, you gotta ask yourself, what's the game plan? Are you saving for a down payment on your dream house? Planning for a comfortable retirement? Or maybe you're just looking for some short-term gains to fuel your next vacation? Defining your investment goals is like setting your destination on a GPS. Without it, you're just driving in circles. Short-term goals might mean taking on less risk with more stable investments, while long-term goals could allow you to be more aggressive, riding out the market's ups and downs. Think of it like this: short-term investing is like a sprint, requiring quick thinking and a keen eye for opportunity. Long-term investing, on the other hand, is a marathon. It's about pacing yourself, staying disciplined, and focusing on the long game. Now let's talk about risk. Are you the type who can stomach the roller coaster ride of the market, or do you prefer a smoother, more predictable journey? There's no shame in being a cautious investor. In fact, it's essential to understand your risk tolerance before making any investment decisions. Aggressive investors, the bulls of Wall Street, are all about chasing those high-growth, potentially high-reward stocks. They're not afraid to embrace volatility and are always on the hunt for the next big winner. Conservative investors, the bears, prioritize capital preservation and steady growth. They're drawn to well-established companies with a proven track record of dividend payments and stable earnings. Remember, there's no right or wrong answer when it comes to risk tolerance. It's all about finding the sweet spot where you're comfortable with the potential ups and downs of your investments. Walking onto the stock market without understanding the different types of stocks is like walking into Baskin-Robbins and ordering a surprise me. You might end up with something delicious, or you might be stuck with something you can't stand. Growth stocks are the Ferraris of the market, high potential but bumpy. Value stocks are the reliable pickup trucks, strong fundamentals. Dividend stocks are steady income generators sharing profits. Market cap is the company's weight class. Large cap stocks are the heavyweights, small cap are nimble fighters. Now it's time to put on your detective hats and start digging into the financials. Fundamental analysis is all about understanding a company's financial health and its potential for future growth. We're talking earnings per share, price-to-earnings ratio, debt-to-equity ratio, and return on equity, the bread and butter of sound investing. Think of these metrics as clues that can help you uncover hidden gems and avoid potential landmines. Is the company's revenue growing? Are their profits increasing? Do they have a manageable level of debt? These are just a few of the questions you need to be asking yourself. Remember, investing without conducting fundamental analysis is like buying a house without looking inside. You might get lucky, but you're also taking a huge gamble. Listen up, because this is crucial. Even the best companies can struggle if they're operating in a dying industry. That's why it's essential to understand the industry dynamics and macroeconomic trends that could impact your investments. Is the industry growing or shrinking? What are the key trends and challenges facing the sector? Who are the major players, and what are their competitive advantages? For example, you wouldn't want to invest in a buggy whip manufacturer at the dawn of the automobile age, would you? Understanding the competitive landscape is like scouting out the playing field before the big game. You need to know who the key players are, what their strengths and weaknesses are, and how they're likely to perform in different market conditions. Now let's dive deeper into the company's business model. What makes this company tick? How do they make money? Do they have a sustainable competitive advantage, a wide moat that protects them from competitors? We're talking about things like brand recognition, proprietary technology, economies of scale, and a loyal customer base. These are the hallmarks of a company that's built to last. Don't forget about the management team. Are they experienced, ethical, and aligned with shareholder interests? The management team can make or break a company, so it's essential to have confidence in their ability to navigate the ever-changing business landscape. Listen up, because this is where the rubber meets the road. Understanding market trends is like reading the ocean currents before you go surfing. You need to know when to paddle hard, when to ride the wave, and when to get out of the water. We'll explore technical analysis, a powerful tool for identifying trends and patterns in stock prices. We'll dive into chart patterns, moving averages, and other indicators that can help you make sense of the market's often chaotic movements. But remember, technical analysis is just one piece of the puzzle. It's essential to combine it with fundamental analysis and a healthy dose of common sense. We'll also discuss the difference between cyclical stocks, which tend to move in tandem with the overall economy, and defensive stocks, which are more resilient during economic downturns. Alright, thrill seekers, this one's for you. Technical analysis can be a powerful tool for short-term traders looking to capitalize on market swings. We're talking about using price charts, volume analysis, and technical indicators to identify potential buying and selling opportunities. But be warned, technical analysis can be complex and requires a deep understanding of market psychology and risk management. We'll explore popular technical indicators like moving averages, MACD, and RSI, and discuss how to use them to spot potential trend reversals and breakouts. Remember, technical analysis should never be used in isolation. It's just one tool in your investor toolkit, and it's essential to use it in conjunction with fundamental analysis and a sound investment strategy. You know what they say, diversification is the only free lunch in investing. Don't put all your eggs in one basket. Spread your bets across different asset classes, industries, and geographies to reduce your overall risk. Think of your portfolio like a well-balanced meal. You need a healthy mix of stocks, bonds, real estate, and maybe even a sprinkle of alternative investments to ensure you're getting all the nutrients you need. Diversification helps to cushion the blow when one sector or company is underperforming. Remember, even the best investors make mistakes. Diversification helps to mitigate the impact of those mistakes and ensures that your portfolio is positioned for long-term success. The stock market is constantly evolving, so it's essential to stay informed about the latest news, trends, and economic indicators. Read financial news, follow industry experts, and subscribe to reputable investment newsletters to stay ahead of the curve. But be careful of the noise. There's a lot of misinformation and hype out there, so it's essential to be critical of your sources and focus on quality over quantity. Remember, knowledge is power in the stock market. The more you know about the companies you're investing in, the better equipped you'll be to make informed decisions. Listen up, because this is crucial. Emotions are your worst enemy in the stock market. Fear and greed can lead to impulsive decisions that can derail your investment strategy. When the market takes a dive, it's tempting to panic and sell everything, but remember, stay calm and stick to your plan. Don't let your emotions get the best of you. Develop a disciplined investment strategy and stick to it, no matter what the market throws your way. Remember, the stock market is a marathon, not a sprint. There will be ups and downs along the way, but by staying disciplined and focused on your long-term goals, you'll be well positioned to weather the storms and come out ahead. In today's digital age, there's no excuse for not taking advantage of the incredible investment tools and platforms available at your fingertips. From online brokerages and stock screeners to financial apps and robo-advisors, there's a wealth of resources out there to help you make smarter investment decisions. These tools can help you research stocks, track your portfolio, and even automate your investments. Take advantage of these resources to streamline your investment process and free up more time to focus on what really matters: making money. Remember, investing doesn't have to be complicated. By leveraging the right tools and platforms, you can simplify the process and make it more accessible and enjoyable. Don't feel like you have to bet the farm right out of the gate. Start small and gradually increase your investments as you gain experience and confidence. Remember, investing is a journey, not a destination. There's always something new to learn, and the more you invest, the more comfortable and confident you'll become. Regularly review your portfolio's performance and make adjustments as needed. Make sure your investments are still aligned with your goals, risk tolerance, and market outlook. Investing is not a set-it-and-forget-it proposition. It requires ongoing attention and adjustments to ensure that your portfolio is still on track to meet your financial goals. Remember, investing in stocks is a journey that requires patience, research, and a clear strategy. Stay informed, stay disciplined, and happy investing. You've got the knowledge, you've got the tools, and you've got the mindset to succeed in the stock market. Now go out there and make your financial dreams a reality.